let me digress a bit and talk about some popular investment styles. Now, we really haven't gone through all of the details of stock valuation. We've been introduced to what an equity is and some simple models to value equity. But there are certain things that are discussed in the market that you should be familiar with, at least in terms of the definitions. Later we will return to these definitions and figure out whether they make some sense in terms of investment strategies. But let me first introduce 4 different investment styles. Now there's many different investment styles, but these are often talked about, and I thought that you should know something about them. The first strategy is a so-called growth strategy. So if you're a growth investor, that means that you undertake an investment strategy that buys high growth firms. Now, growth is usually calculated in terms of the percentage change in earnings over the past year or the past 3 years, or sometimes the percentage change in sales. Now, what people usually do is to sort different securities based upon this attribute, this growth attribute, and pick out the ones that satisfy the criteria that there's high growth, and undertake an investment in these securities. And this is called a growth strategy. Another popular investment strategy is the so-called value investing. Now in this case, what you do is you look at the ratio of the market value of the firm, and that is the number of shares outstanding times the price of each share, and divide that by the book value of assets. Now the book value is an accounting number that does not necessarily represent the market value of the assets. Is what are the assets carried on the books as, the so-called book value, which I'm sure you're familiar with from the accounting courses. So this so-called price to book ratio is used as another attribute. So we look at all the stocks in the market and sort on this price to book value attribute. And we select securities that have low price to book ratios as securities that are perhaps undervalued. So the value in the market isn't perhaps fully realized according to this ratio. Now, this is an investment style called the so-called value investment style, and there is some empirical evidence that suggests that this investment style tends to have higher average returns than another passive investment style. But let me stop right here and give a caveat. It's possible that the investment in these low price to book value firms is an investment in firms that are just distressed or that have higher risk. So perhaps it's no surprise that the average returns on these firms are higher than a passive portfolio of many other stocks in the market. This goes back to one of the very first lectures on the fundamentals of risk and return. That if the security is riskier, it makes sense that it should command a higher expected return. So when we do this value investing, it's possible that this value attribute is just a surrogate for the risk of the securities that you're buying. As I said, there's plenty of empirical evidence that suggests that this value strategy tends to identify securities that have a higher average return than the market as a whole. I guess my interpretation of this, that is probably risk-based. Now, I could also make the same argument for the growth strategy. The firms that you're selecting based upon growth are most likely to be fairly young firms and most likely to be the firms that are the riskiest firms in the market. So they might have great growth last year or the year before, but you just don't know what's going to happen in the future. So again, this could be a surrogate for risk. Now there's other types of investment strategies that I'll mention. One is a momentum strategy. And in this case, what you do is you look at the returns on the stock for the previous year, and you purchase the stocks that had the best return in the previous year. And the idea here is that perhaps all of the value has not yet been realized by the market, and it's the so-called jump on the bandwagon strategy. This is the momentum strategy. Now, there's another strategy which is basically the opposite of the momentum strategy, and it's called the contrarian strategy. The contrarian strategy does the same exercise of looking at the gains over the previous year or the previous quarter and takes the opposite position to the momentum strategy. So the contrarian suggests that, well, maybe the market overreacted in delivering a 25% return for this particular security, and next year the return will be negative or very low. So the contrarian actually goes against the market, thinking that there's been some sort of overreaction by market participants. Now these two strategies are much different than the value and growth strategy because one is the opposite of the other. And again, you have to be careful that these strategies are not just proxying for the risk of the individual securities. Now what we need to do in order to evaluate these two different strategies is to develop some models of risk and return, whereby we can actually see if it is the case that the portfolio based upon any one of these strategies delivers a higher return than average in the market. We need to check to see if that is due to the fact that this portfolio is riskier than the market as a whole. If it's riskier and it delivers a higher average return, then really it's not a big deal in terms of investment. We know that a riskier strategy needs to have a higher expected return. So what we need to do is not just label these investment strategies. We actually need to go and figure out how to evaluate these investment strategies. And that comes much later in the course, but we'll get there.